let's go into the biggest concept to kind of get this started off, which is called the rich man's Roth, or in other words, why this cash value life insurance has been termed the rich man's Roth. Because what I need to do in this presentation is I'm essentially going to break down separate concepts and basically show you how, when you pull them, if you understand these separate concepts, when you need to pull it together to do whatever kind of investment you want to do, it's going to make perfect sense. So the first concept I want to break down is the rich man's Roth. Why do they call it the rich man's Roth? In other words, building tax-free wealth with life insurance. So again, this is right out of one of the earlier books. So actually, it's not all that complex. It's amazingly simple, once someone explains it to you. So let's first do a comparison. When you look at these different products that we are talked about, Roth being one, 401k, IRA, 529 plan, and so many times we're told about how beneficial these are. Hey, you should get a Roth. Hey, you should get a 401k. Hey, you need to open an IRA. No problem. Why? What, give me the benefits. So if you look at things like tax deferred growth, well, they all have that. Tax free withdrawals, only the Roth has that, and only the 529. Only problem is the 529 which is the college plan, you can only take money out for education. If you take money out for anything other than that, you get taxed and penalized on your own money. But if you look at things like investment without risk, no. Principal protection, your principal is not protection. No stock market loss, that's a no. No penalty. So as you go down the list, there's very few, of things that we ideally would like. There's not really that benefit that we can see. I mean, the Roth obviously has more than the others, which is why a lot of people like a Roth. Tax-free with tax-free growth, tax-free withdrawals, and then no penalties. That's great. But if you compare it to some other solutions, you actually see there's something that, if you compare apples to apples, that is actually better than a Roth. It beats the Roth at its own game. The second one is a fixed index annuity. We're not going to go into that. That's a whole nother presentation. But as you can see, the index universal life basically is head and shoulders over everything else. So I wanted to show you this first, because when you talk about why they call it the rich man's Roth, just from a comparative perspective, this is one of the reasons, because the wealthy people are looking for, well, we all are looking for this. It's just that they understand this is how you get these things. Principal protection, no stock market loss, no penalties for early withdrawal, no penalties for late withdrawals. That's your required minimum distribution. Once you hit 70 and a half, they make you start taking money out of your 401k. So a lot of these things go away, and it's to our benefit. So this is just kind of an apples to apples comparison of an index universal versus Roth. So that's high level. Now let's go and get into the specifics of why they call this the rich man's Roth. So when you're looking at a Roth, as some of you might know, it's first of all, with a Roth, you can only make so much money. I think the number right now is $139,000 if you're single, $205,000 if you are married, household. So for people who make more than that, they're automatically excluded from the Roth again. So people who make more than that, what do they do to kind of take advantage of the Roth? Taking advantage of Roth type benefits and not get in trouble with the IRS. Well, they use a cash value life insurance, but they use it as if it was a Roth. All right, so let's break this down. So what you're looking at is something called in a illustration. This is what we run when when we're trying to work with clients and see how much are they going to pay for their insurance or how much coverage. We run an illustration. So I'm going to break this down so you really understand what all these numbers mean, and I think the idea will start coming to you. So now this is just a hypothetical, so don't just follow along in terms of the numbers. So in this particular case, this person, I think it was a young lady I was doing this for, opened up a $2 million policy. Now, ironically enough, for the purpose of this conversation, I'm not even really interested in the size of the policy. The only importance I want you to know about the size of the policy is this: the bigger the policy, the more money you can shelter from taxes. That's pretty much it. So if she had $1 million policy, that means she could put half as much money in it, which means she would shelter half as much from taxes. So just understand, it's like an umbrella. You got a big umbrella and you're in the rain, you probably won't get as wet. You got a small umbrella, probably gonna get wet. But in this case, rain is equivalent to taxes. All right, so next one I want to show you in terms of the rate of return. On average, and this is actually below the average, but in terms of the rate of return for this financial instrument, you're like at 7.2%. That is very good. Most time it's outpacing what the stock market is getting, and you're getting this inside of your insurance product. So again, for a wealthy person, they're looking at that more than anything, because they just want to know what kind of rate of return am I getting for my money, coupled by the fact that with this, my money is not at risk, because we saw the earlier chart with the blue line where, hey, my money is always going to go up regardless of what the market is doing. I'm not going to lose any money, but I could pretty much be comfortable with on average of 7%. I'm probably, some years I'm going to get more because I can get as much as 15. Some years I'm going to get 0.75. So I know on average I'll be okay, but maybe not most importantly, but extremely important is that what I also know is I'm not ever going to lose any money. So that means I can sleep pretty well at night. All right, so now let's talk about how we fund this, how we put the money in, because we're talking about a rich man's Roth. So first of all, let's go with this particular person is looking at putting $2,500 a month in. They can afford that. May or may not meet other folks on this call, but let's just talk about that for a minute. So that's essentially $30,000 a year. Where first of all, even if you were in a category where you could use a Roth, they're not going to let you put $30,000 in there. Even though they've made this product where you can put money in tax deferred, it can grow tax free, and you can access it tax free. The government says, but we're going to limit how much you can put in it. You can only put $5,000 in there a year. Oh, actually, it's up now. It's $6,000. So regardless of how good this is, the most you can put in is $6,000. Well, something that good, you probably want to put as much money as you could, but they don't let you. If you're over 50, they let you put in another $1,000. So the most you could put into a Roth, any Roth at any time, regardless of how much you make, is $7,000. So already we've gotten around that situation by opening up this, because we can literally put in, well, $30,000. Well, we can put in more than that, but we can essentially decide how much we want to put in. We're not limited to how much we can put in. We can put in as much as we want. The only thing is, if we want to put in more, we may have to increase our policy so that it will fit. All right. Now, so the 2,500 is just what this person decided they wanted to put in. It's not a requirement. So let's go back to from the life insurance perspective, the minimum. There's a minimum that the insurance company says, as long as you put this amount in, you'll always have the life insurance policy. So, and it's called the target premium, but just think of that as the minimum for now. It's not really the minimum, but I want to keep this simple for you. So we're going to put 2,500 in, but we only really need to put 1,300 because, you know, all the insurance company is concerned about is you keeping the policy in force. They're not really focused on you building wealth. Now, you can build wealth if you want to. That's just not their focus, but that's our focus. But we got to understand how it works. So, but here's the thing. Of that 1,301, that is our monthly premium, there's something going on behind the scenes that we really need to know. Part of that, or $517 of that 1,301, is going to something called the cost of insurance. So really what's happening, that 517 of the 1,301, that's the part that's going to pay for the insurance. The other 783 goes to the cash value, which means that's the money that goes to us, that goes to account for us. So when people look at this 1,301 and they're, you know, I was the same way. The immediate response is, wow, that's a lot of money to put into a life insurance policy. Assuming, let's just assume you just want a regular life insurance policy. You didn't know anything about cash value or doing real estate. You're like, wow, that's a lot of money. But what you need to realize is that most of that money is yours. You're essentially paying yourself. Now, we've all heard the terminology, pay yourself first. Again, this is why wealthy people like this, because it's like an automatic way, or you could put that on autopilot where, yeah, I'm paying 1,301 and, you know, a small part is going to give me this nice big life insurance. But actually, most of the money that I'm paying to myself. So that 783, that's the cash value, that's you paying yourself. Okay. Now, this is important too, because this is something called a 7-pay, which basically means this is the most we could put into the policy at any one time. And you're going to understand in a minute why somebody would want to put this amount of money into a life insurance policy. There's a very good reason. But the IRS basically said once people kind of figured out how they could use this to get around paying taxes, the IRS put a limit on it. Say, you know what? You guys are smart, but we're smarter. So we're going to limit how much you can put into any policy. Now that limit changes again with the amount. The smaller the amount, the smaller the limit. The larger the amount, the larger the limit. So let's say if you wanted to put $88,000 into this, then you would need to get a $4 million policy. So it's relative. So they're like, okay, you can put more in, but you got to buy a bigger policy. Okay, maybe you can afford it, maybe you can't. So that's their way of kind of limiting how people use this. So really, the way to think about it, it's like a cup. This is all these IULs like a cup. This is the best analogy I've ever heard when it comes to understanding this. It's like a cup. And what happens is, you know, like any cup, there's a minimum that you can put in. Because, you know, if you're going to drink a certain amount of liquid, you need something to drink out of. So there's a minimum amount that you want to put into the comp. This is our target premium. This is our minimum. Part of that goes to the cost of insurance, and in certain situations, depending on your type of insurance, it goes to your long-term care too. But let's just focus on the cost of insurance. But like I said, the other part goes to your cash value. Now, this is the minimum. So the company says, whatever amount you put in, we're going to make sure some of it goes to your cash value, because that's the benefit of having this. We want you to have money that you can use. Okay. And I like to call this your savings or your live money. So this is money you can use while you're living. Kind of freaks you out. It's like you thought we're talking about life insurance. We are, because I want money that I could use while I'm alive. Now, if we remember the numbers, so our cost of insurance on the example we gave earlier was 517. The cash value every month, that 783 is going to our cash value account. So actually more of the money is going to us than it is going to the life insurance company. And that's going to be important for one of our next, when we get into the real estate part of this. All right, so now, but the cup is still not full. This is just the minimum. There's a lot more room in the cup. So again, the way these work is that anything you put in, or any amount of money that you put in above the minimum, all of that goes to your cash value. So now you're saying, okay, well, 517 is going to pay for the insurance, 783 is going to my cash value. That's if I'm paying $1,300. But if I'm paying more than that, anything above that goes to the cash value. So in other words, my cost of insurance, there's never going to be a time where I pay more than 517 for my insurance. I don't care how much money I put in here. Anything more than that is going to go to the cash value. So if we look at our, our example where we're putting 2,500. Okay, well, 517 is going to go to the cost of insurance, but 1983 is going to go to our cash value. So that's the money is coming to us. If we decided we wanted to pay the max, that 4482, which is basically 37.39 a month, again, cost of insurance is not going to change. Cost of insurance is not going to change. But the amount of cash, the amount of money that's going to our cash value is going to increase. So again, let's think about this like the wealthy do. I have a tool where I know my money is going to grow tax-free, tax deferred. I'm going to be able to access it tax-free. I'm not going to lose money. I'm going to be able to access it at some point in time. Am I trying to put more money in, or I'm trying to put less? Well, obviously you're trying to put more, but the ideal is just how much more can you afford? Because, just paying the minimum is good if you're just looking to have a life insurance policy. But being able to, this is what we call overfund. This is overfunding your policy, where you're putting in more than you need to, but the benefit is all that money comes to you and it grows tax free. All right. So again, see, there's our numbers. There's 25. There's this is the bottom of the cup. This is the top of the cup. So this is kind of lets us know why, from a strategic standpoint, we would like to put ourselves in a position where we can overfund it, because that money is essentially going into an account that we can use and is growing tax deferred, and we can use it tax free. So that's kind of like a win-win-win. All right, so let me just back up here and look at this part. So when we're looking at these illustrations, it's pretty straightforward. This column, it shows the age of the person, how many years they're in the policy, what their premium is, and this is yearly. So again, 2,500 times 12 months is 3,000. We'll get into the withdrawals and the loans in a minute. The cumulative amount, so this is just showing every year cumulatively what have you put into it. And then here is our policy value. So here is that 783 every month going in here, plus the annual rate of return of that 7.2%. So this is our money growing. So what we're looking at here is this is our money in the policy. So you want to pay attention to the policy value and the cash surrender value. The cash surrender value, however, this is how much of your money you can access at that particular time. So you'll see year one, you see a big fat zero there. Even though make no mistake about it. This is your money, but this is how much you can touch. And I'm going to break this down in a minute. Now, this side, again, we're not going to talk too much about it, but it's a life insurance policy. So God forbid something happens to you, this goes to your family. Also, if you were to need long-term care or some other unforeseen illness, you could usually, the first year, you could use this amount of money, even though you really don't have access to any money. All right, but so let's get back to using this as a rich man's Roth. So this is why wealthy people use these sort of tools. So let's look at this again. We're focusing on the policy value and the cash surrender value. We're putting this money in. Now you see these numbers on this side. So I think hopefully you understand a little bit more now why it actually makes sense that as people either begin to get raises, they pay off bills, they pay off their homes, their cars, their student loans, they become investors, they actually put more money in here. Because we just saw the cup. Any money I put in here over that 517 is basically coming back to me tax-free, and it's going to continue to grow. So I'm creating a tax-free bucket the more money I put in here. So again, on the surface, you know, when you look at this and you're like, $3,000 or $30,000 a year in a life insurance policy, that's crazy. Well, it's not crazy when you're getting most of the money. Basically, what you're doing is you're creating it's like a savings account, or what I like to call a growth account, because you're not going to get a savings account that's going to pay you 7%. But your account here is going to grow at 7%. But now that I'm dumping this money in, and let me just say this about that earlier book where we say infinite banking. So infinite banking takes the concept of, I don't just put money in here that I want to put into that I want to invest. I put money in here like it's a checking account. Like I put my whole check in here every month. Why? Because I can turn right around and take it out here. Now, in this type of insurance policy, it doesn't work as well until you get maybe past year 10. There's some other policies, which I'll talk about later, where the first year, these numbers are almost equal. But so it doesn't work as well. It's like anything else. You have certain tools for certain situations. Meaning, if I'm trying to drive from here to New York, you know, and I want a nice, smooth luxury ride, maybe I'll get a BMW or Mercedes. But if I'm trying to drive off-road, I need an all-terrain vehicle. I need a Jeep or something like that. I can drive a Jeep on 95, but I'm not going to get there in the same way, in the luxury and the style I would if I had a 7 Series BMW. So again, the insurances are the same way. You need to know what your specific objective is and then get the right sort of vehicle to do that. So this vehicle is more for mid and long-term investments and growth potential, that higher rate of return. The other ones you can use, you can have, and I'll talk about this later, where you can have cash value. You're just going to have a lower rate of return. So you got to pick, you know, you want more money, you want access to your money now, or you want more money later on when you're ready to retire. And there's no wrong answer. Okay, so again, we're dumping all this money in with the idea that we're going to be able to access this money pretty much when we want to. Anytime we see money in the cash value, this is our money. That's the money we can touch. And you can touch that money tax-free, question-free, penalty-free before you're 59 and a half. So, you know, for those of us who are already almost 59 and a half, that's not as big of a deal. For those of us who are younger, that's a very big deal, because even with the Roth, again, why do they call it the rich man's Roth? The Roth IRA, with all these benefits it has, tax deferred growth, you can access the money tax-free only after you're 59 and a half. So if you have a Roth and there's an emergency and you're 50 and you need to access your money, you're going to be taxed and you're going to be penalized. That's not necessarily a good look for most people. So, but in this situation, that's not the case. Anytime you see money in your cash value, that's money that you can utilize tax-free, penalty-free, question-free. All right, so let's go. I just want to run through this scenario, and I want to break down the big picture, then I'm going to start to dissect it. Okay, so we do that for a period of time, and I want you to pay close attention to, let's go back to this one thing where at some point in time, we want to stop paying into this policy. So it's another thing that separates this from other type of policies. Some, I'm sure we've all heard whole life, or where basically you have to pay in your whole life. It's not that kind of policy. Just like you pay off your house, just like you pay off your car, just like you pay off your student loan. Well, I'm going to use the example of the house because that's more applicable. Just like you pay off your house, you want to pay off your house and have an asset that's free and clear that continues to appreciate. Same thing here. I want to pay this amount, a certain amount into this. I want to stop, but I want the value of it to continue. It's actually very, very similar to the more I do this, the more similar to real estate these type of tools are. It's just that, again, a lot of people don't talk about it. All right, so as you see here, we stopped paying, and over the course of 20 something years, this person put in $1.1 million. But look at their policy value at 60 is like $2 million. Their cash value, surrender value is $2 million. But even though they're not putting any more money in, this is continuing to grow. 2.4, 2.6, 2.7, 2.9, 3, 3.2, 3.4. How is that happening? Well, this is an account, and you're getting on average 7% a year. So this money is growing, and you're not doing anything. Oh, by the way, remember, with the index, I don't lose money. So I'm never going to wake up tomorrow and see 40% of my money gone, 30% of my money gone, like we did when COVID hit. The worst thing that's going to happen, I'm going to see a lower return. I might see 0.75. 0.75 on $3 million, I'll take it. 15% on $3 million, I'll take that too. So I'm always going to be somewhere in between. So again, we're paying attention to the policy value and the cash value because this is our money. The reason I'm not ignoring the other things, I'm just saying I'm interested in what I get while I'm alive. My family's going to be fine when I'm not here. But what can I do with this money while I'm still here? So we see that they stopped putting in at 60, whatever, what is that, 67 or something like that. That money has now grown. Now it was growing the whole time. So this is what you put in out of your pocket, and this is what it's grown to. So just with that, from an investment standpoint, that is, hold on. Okay, yes, sorry, back up. That's almost 300% rate of return. Not bad. I put in $1 million, I get 3.4 million. But I put that in over a period of time. And again, I incrementally increased it. And this is why I dumped so much money here, because I knew this is a lot of money, but this is a lot of money too. And where else would I put that money where I know two things? One, I'm going to get a good return, and two, I'm not going to lose it. I could have invested this in the stock market. I doubt if I would have this. But let's say I was lucky enough to where I put this amount of money in the stock market, and this is the return I got. Am I going to get $3.4 million? No. Why? I have to pay taxes on this. So it's a win-win-win. Once you really understand it, it's like, well, it's a no-lose situation. That's another way you can put it. All right, so now let's say I'm actually ready to retire. And this is part of the reason you want to do all of this, is because you put in X, you get out Y, and now you can essentially create a tax-free stream of income starting, well, in this situation, right around 68, of about $225,000 a year. This money is tax-free. I can't emphasize the aspect of tax-free. Why is that important? Because in order for you to do this with your 401k, you would need to pull out somewhere in the neighborhood of like $300,000 a year in order for you to get $225,000 tax-free. And that may not even be including state taxes. So the tax-free aspects of this is huge. Now, and because we've had this large amount, we're able to initially, we do a withdrawal, which means we just take out the money that we put in. But then after that, we switch to a loan. And what are we borrowing? What is this loan based on? The loan is based on the policy value. So every year, remember, this policy value is paying, and I'll break this down in a minute. This policy value is growing at 7, 8, 9, 10% a year, but I'm taking out a portion of that. So 10% of, $3.5 million, that's $350,000, but I'm only taking out 225. So you'll see, my policy is putting money in, I'm taking some out. My policy is putting more money in, I'm taking it out. But so eventually you'll see the policy value continues to grow up, but your cash surrender value is going down, meaning that's the money that you can touch. Like I said, I'm going to touch on that a little bit later. So let's say the maximum at 90, this person pulls out is $4 million. So if you add this money that you put in, tax-free, plus the money that you got out from the loan, tax-free, you actually were able to pull out $5.7 million tax-free, but you only put in, or you only funded $1 million. So that's a much better return than even this 300% because you were able to do it strategically. So again, I'm talking about the rich man's Roth. Why wealthy people use this instead of a Roth. A Roth cannot touch this. It just can't. It's nothing wrong with a Roth. It just doesn't work this way. So once they understand, oh, this is how it works, then this is what they do. And oh, by the way, if this person passed away at 90 years of age, their family still gets one after funding $1 million, after pulling out a total of 5.7, their family still gets close to $2 million as their legacy or generational wealth.